Hello, I'm Mario Toneguzzi, managing editor of Canada's podcast, Taking Care of Business today with Dan Kelly, president of the Canadian Federation of Independent Business. Thanks, Dan, for joining us today.
Good to be with you.
Okay, let's talk a little bit about the hike that's coming in the capital gains inclusion rate. First of all, for people, explain what that is.
Yeah, sure. Look, if for an individual, if you own a property outside of your home, or you have an investment portfolio that isn't protected like an RSP, any gain in the value of that when you sell it is considered a capital gain, and a portion of that then is subject to tax rates that you would pay on your income. For business owners, of course, this is even more profound because for many of them, it is the eventual sale of the business that they have as their retirement savings. They're hoping to sell their business one day, either as a going concern, or perhaps the assets like its property or equipment. And that money then is potentially now subject to a higher rate of capital gains taxation. And then the third way that this can affect business owners is if in their corporation they have some investments, like they might have, they might own a strip mall, or they might have a stock portfolio within their company.
Yeah.
That now is subject to a higher rate of tax. And so this is now going to bite them on that front too.
So, in terms of this could have a significant impact on entrepreneurs across the country.
It sure could. Look, now there are some positives in the capital gains changes. There is an increase in the lifetime capital gains exemption for business owners that sell the shares of their business. There is also something now contemplated called the Canadian Entrepreneurs Incentive. Again, if you sell the shares of your company, you may qualify for that and be better off. But for many, many other businesses, we estimate over half of Canada's small businesses, this is going to be a net takeaway, and they're going to end up paying higher taxes as a result.
Well, here's the thing: the federal government, the liberal federal government, has positioned this as it impacts the wealthiest people out there. But that's not the case, is it?
No, and this is why we are taking this so seriously. This is far more than a tax that's going to affect the uber rich. The government is suggesting that 0.17% of Canadians are going to be affected by it. That's of individual Canadians. But even the federal budget admits that on an annual basis, there are over 300,000 corporations that will be affected by this change. So this isn't up for subjectivity. It isn't just our data that is saying that the incidence of this is far higher. The federal government admits in the fine print that huge numbers of corporations will be affected by this change in a negative way. And so while there are a few positives in this package of changes, we are very worried about the increase in capital gains, because for business owners, that means that there's less that they have to rely on for their own retirement. But also, many business owners save within their corporation so that they can invest in, say, the creation of another company, or perhaps in investing within their own business. And we're now going to tax more of that money away, meaning less of it can be put back into productive use for the corporation itself. And that, for small businesses is a big deal. I talked to the owner of a candy store in Winnipeg that said that her business, because of the structure that she had when it was created, that when she ultimately sells the business property, she's going to see far more of it taxed away than she would under the previous rules. And that's just not fair, especially to aging business owners who are seeing their retirement savings eroded very, very quickly.
So what's the CFIB recommending to the federal government regarding this?
Yeah, look, we're recommending a bunch of things. One, there's a lot of ways that the federal government could take to try to reduce the impact of this increase. We'd like to see them scrap the whole idea of increasing the lifetime capital gain, increasing the inclusion rate. But if they're not prepared to do that, they could allow business owners to have up to $250,000 a year at the current levels. That's what they're doing for individuals. There's no reason that can't be applied to business too. Secondly, they could grandfather all the existing capital gains so that this tax effect could be then for future gains, but not if you're, effectively what the value is on June 25th, you wouldn't be affected retroactively by that. And that to us would be a fair provision. On top of that, we're asking the government to look at this new Canadian Entrepreneurs Incentive and to expand it to allow all business owners to qualify for it. That would be another way that they could reduce the impact of this change. Right now, it is a confusing mess. They're putting in this new tax policy. If you're a retail store, you qualify. If you're a restaurant owner, you don't qualify. If you're an accountant, you don't qualify. But if you own a manufacturer, you do, a manufacturing business, you do qualify. That makes no sense. We can't figure out any public policy rationale. This package needs to change, or they need to ditch the idea of increasing the inclusion rate in the first place.
All right, wonderful. Thanks, Dan, for joining us today.
Anytime at all.
All right, that was Dan Kelly, president of the Canadian Federation of Independent Business. I'm Mario Toneguzzi, managing editor of Canada's podcast, Taking Care of Business Today.